Welcome to RWA on XDC, where we teach you about the intersection of real-world assets and blockchain technology. Today's episode is about RWA and DeFi Ecosystems, featuring Fathom. Today's guest, Manuel, the co-founder of Fathom. Welcome to the show, brother.
Thanks, Joshua. Great to be here.
All right, so for our listeners, give them a quick introduction of Fathom and what you guys are doing for the industry.
Yeah, okay. Maybe I can give a little bit of a backstory on Fathom. So the Fathom team all met at a company called Securrency. Securrency is a US-based fintech focused on tokenization and regulatory compliance of digital assets.
Okay.
So we were working with a lot of banks and especially asset managers on tokenizing their funds. You know, everybody was going to us, we want to tokenize funds. So we had like Wisdom Tree Asset Management. BlackRock is the most famous recent example, right? They just tokenized a big fund.
Yeah.
And the question was always, okay, now it's tokenized, what's next, right? It's not like there's lots of liquid marketplaces out there for these funds to be traded.
Right.
And so, you know, we set up a team within Securrency that was kind of a lab, like kind of a innovation kind of division that focused on using DeFi, decentralized finance, as distribution for tokenized real-world assets. So that's kind of the backstory. And then we spun that division out in September of last year, and we set up as an independent entity. So we have a development shop, and then there's a DAO that we incorporated as well that takes care of the governance of the protocol.
Okay. Is your team decentralized as well?
Oh, absolutely. So we have people in the US, in Brazil, in Turkey, in Ukraine, in Russia, in the UAE, and in Korea.
Okay, cool. Now, what would you say is the main product you guys are bringing to the market?
So you can think of Fathom as a liquidity protocol for real-world assets, as I touched upon earlier. So for those that have real-world assets like tokenized bonds, or it could be gold, or it could also be an L1 token. So you can combine it with traditional crypto assets. Which is in fact what we started with on XDC with Fathom. Take XDC as collateral, and later on take real-world assets as collateral, and then turn that into a stable coin. And that's a US dollar pegged stable coin. So the most liquid real-world asset out there is the US dollar, obviously. And this is what people with assets that might not be that productive or not that liquid, or that they might not want to sell because they think XDC's price will go up, or even there might be regulatory constraints on Reg D fund, perhaps, that you cannot sell in the first year of investing in it. So for these kind of assets, you can still use that as a basis to borrow stablecoin against. And with that stablecoin, of course, you can do many, many things: trading, investing, paying, etc.
What types of assets would be put into these types of funds? Would it be homes, buildings? Could you go more specific on that?
Yeah. So if you think about that, what comes out of it on the other end is stablecoin. The first logical asset type is the L1 token itself. So in our case, that's XDC, or it could be Ethereum, or any of those L1 tokens.
Yeah.
The second has to resemble as much as possible that output asset. So what's the most akin to the US dollar? It might be a US Treasury, fixed income bond, or a fixed income portfolio. Or it might also be gold. Gold used to be the basis for issuing US dollars, of course. So fixed income like instruments, gold, and in XDC's case, because it's so focused on trade finance, it might also include trade finance funds, which is still fixed income. That you can think of them as private loans. These are good assets. Homes and real estate is difficult because real estate is very idiosyncratic, and to make the jump from like a building here in Dubai to a digital token that really represents that building and creates a legal link with that building is difficult. And plus real estate, real estate here is different from where you are. And so it's not a very fungible asset type.
Okay. Yeah. So I guess what I was trying to get at is what type of funds would you borrow against? What type of funds would you borrow against to get your liquidity out of an asset?
So these would be fixed income funds, for instance.
Okay.
These would be trade finance funds. Assets with low volatility, with little risk of liquidation, which is important. If you have very volatile assets, then you might be liquidated. And preferably with intrinsic yields, which these funds have.
Yeah, because when you're thinking about big money, you don't want to get liquidated on something that could be you could be taken advantage of in the marketplace with a volatile asset.
Yeah, and we have to be very protective of the protocol in assuring that the collateral that we onboard features these criteria. So low liquidity, low volatility, high liquidity, as close as possible to the output asset, the US dollar. So treasuries, gold, that makes sense to us. Real estate, if you have a very diversified real estate income portfolio, so if you can put that together into some kind of mortgage-backed security or so, where it's not so much hints to the real estate itself, but it's really a diversified portfolio of income streams, of rental income, for instance. That's a fixed income. Right? So that would work as well.
That's where it gets scary because you think of the Big Short. Yeah. And when you go mortgage-backed securities and you're lending and borrowing against them, that's where it gets crazy in the real world. So let's get back to the FXD, your stablecoin, and talk a little more about that. How is it backed? And where can you access FXD right now?
Yeah. So if you have assets that are accepted as collateral, so for instance, if you have XDC crypto, you can deposit that into a CDP, collateralized debt position. And you can borrow against that up to 75% loan to value. And then with that, the FXD is minted. Now, if you want to redeem and get your XDC back, you pay back the FXD and you get your XDC back. So that's how it works. That's for people who have maybe a large amount of XDC that they don't want to sell.
Don't want to sell, yep.
Because they think the price goes up or because they don't want to pay tax on it. But they need that liquidity, they can do it this way. And then, of course, you can just buy FXD on a centralized exchange or on decentralized exchanges, including Fathom's own decentralized exchange DEX.
Do you guys have a platform yourself where users can interact?
Yeah, so anybody with an internet connection and needs to get a MetaMask wallet, and they can deposit collateral into the CDP, borrow and mint. It's very straightforward, and they can then also trade on the DEX or deposit FXD in a vault and earn yield on it. So it's, that's DeFi, right? So it's open for anybody. It's permissionless.
Now, for FXD, when an end user is listening to this and they want to know more about how it's backed and how they guarantee it keeps its value, can we talk about that a little bit? You said the XDC represents 75% of the collateral, so it's over-collateralized by 25%?
So right now, 100% of the collateral is XDC. We haven't opened it up yet to other asset types, but that will happen very soon. But the amount that you can borrow, so if you have $100 worth of collateral, you can borrow up to $75. Stablecoin. But we don't recommend it. You give yourself a bit more margin because there is a liquidation mechanism that if the value of your collateral drops, of course, then
you could be liquidated.
it can be liquidated. You have to put up more collateral, or borrow less. Yeah.
Okay, I think I misunderstood when I originally asked that question. 100% of the liquidity you provide is in XDC, and you can borrow against that up to 75% of the liquidity you provide.
Yeah. So right now the collateral portfolio is 100% XDC. So that's going to change. And you can borrow up to 75% loan to value. So the value of your collateral, which is 75%, which means if you do it the other way around, that it's 133.33% over collateralized.
Okay.
Yeah.
That's cool.
And
now,
this is key that, this is an over collateralized stable coin. This is very different from Luna Terra, these algo coins, or what we see these days, very popular but very dangerous USDE, which relies on off-chain derivatives trades. So in our case, it's, I think, for security purposes, it's often very wise to keep things simple and secure. And I think you want to talk about security a bit, but that's kind of a key element of it, that it's over collateralized, not by our own stablecoin. We have the Fathom token as well. And we will never use that as collateral, because that's like a self-fulfilling prophecy, and that's what went wrong with Luna UST. But it's an exogenous collateral type, high quality, and of course real world assets to be added. And in the end, 90% of the security of a protocol like ours depends on the quality of the collateral. That's the most important, and the transparency of that quality, and of course the liquidity of it.
Now, when you speak of other options for providing liquidity in the future outside of XDC, can we talk a little bit about options that you guys are thinking of adding? And then when you think of regulation, who do you guys answer to when it comes to regulation?
Mm-hmm. So the logical assets for us to add is assets that are already available on the XDC network. So if we limit ourselves to the XDC network, so we have Contact Gold, which makes a lot of sense. We have trade finance tokens developed by a trade tech like Trader. That makes sense. And then where most of the liquidity is captured or is captive, I would say, on XDC is on these master nodes. It's a delegated proof of stake network, so a lot of XDC is sitting on these master nodes. And delegated proof of stake and not proof of stake, there's no liquid staking tokens available on XDC. So instead of working with liquid staking tokens, we are looking to tokenize these master nodes and bring that in as collateral, which is over $100 million, maybe $200 million worth of value that sits there, that we think is just a very logical place to start with, to use as collateral for the stablecoin. Regulations you mentioned. So we see regulators focusing on so-called systemic stablecoins. So these are stablecoins that are not part of a liquidity protocol like ours. It's simply the exchange of $1 that sits in a bank account for $1 that sits on chain. So there's no liquidity solution there. And these are, of course, the famous USDC, USDT, everybody knows. These are also the most, and when you think of keeping things simple, that's the most simple concept for people to grasp, and that's why they're so popular. But they come with their own risks, and these include transparency. These include, what happens if the banks that they have their collateral on close, like we saw last year, quite a few of those events happen. And in the case of USDC, they operate in a jurisdiction that is extremely hostile to crypto. And in the case of USDT, it's all, there's a lot of trust in hoping that the team does a good job and doesn't run away with the money. So in our case, it's purely programmatic. It's pure on-chain, and we are the so-called non-systemic stablecoin. We don't touch the banking system, which is where regulators put all their focus on, as they should. So they should look at regulating the ports to the ocean. They shouldn't look at regulating the ocean itself.
Right. Now, when you think of an end user who wants to verify the assets and collateral, is there a way for an end user to verify that themselves?
So it is pretty transparent. So if you're not a smart contract coder, which most users won't be, if you are, that's great. You can just check the smart contracts. If you're not, we have we display the collateral, of course, on our website, but also on CoinMarketCap, DeFi Llama, Gecko, etc. Yeah.
So they pull that data feed, and the data feed will display it?
They pull it straight from the BlockScan Explorer, which just checks the chain itself. So they don't trust our word for it. They get it from these API endpoints provided by the XDC BlockScan team.
That's cool. Now, we've been speaking about XDC. Can we go into why you guys decided to build this type of product on the XDC network?
So we like XDC for several reasons. First of all, our engineers are people who have been working on EVM-compatible blockchains, particularly Ethereum and other chains as well. So the fact that you can just use Solidity contracts on XDC is very easy. So it didn't require any learning of new languages. And it's, in our case, it was so much better than Ethereum, because deploying some of these smart contracts on Ethereum the deployment of a contract can cost you like $60,000 sometimes. That's not even looking at user fees for lending, borrowing, trading. So in XDC's case, it's extremely cheap. So, less than a cent often. And of course, because it's delegated proof of stake, it's also extremely fast. And now, because their focus was also always a bit institutional, they also have this arrangement where the master nodes that provide the security and the consensus, they're all KYC'd. So if you're dealing with an institution, these institutions ask some what we might think of funny questions, but they're like, well, we like public networks because, what's the point of a private network? Although, banks in the US don't have this privilege at the moment to be able to work with public networks because of the regulator, but most people understand that it has to be on public networks.
Right.
Then they have to answer some of these regulators and policymakers, and they have to make sure that the block that confirms their trade, for instance, wasn't produced by Kim Jong-un's team in North Korea.
Yeah.
And then with Ethereum, you can never tell. But in XDC's case, they have this compliance layer as well, and they had this focus on working with institutions from the outset.
When it comes to the security of the Fathom protocol and how it is audited, can we talk about that a little bit?
Sure. So just building on what I mentioned before is that, first of all, a big part of security is that, keep it simple, keep it transparent. People have to understand how it works, because, who has the time to dive into white papers and smart contracts? So in our case, it is kind of safe because we have high quality collateral. It is over collateralized. We're not using derivative games in the background. And we have this USDE that's very popular at the moment, but I know even some of the top DeFi people, they don't really understand where the risks are. It's mainly in quality and custody. But for layman, it looks all great. So that US Terra, right? It looked great. and you had big names in the industry that
backed it and believed in it. Yeah,
put Luna tattoos on their arms, even, right? And then it all went wrong. So in our case, it's over collateralized, so that makes it already that's very important. And then you need good engineers. It's kind of easy to get to get stuff outsourced. We haven't done any outsourcing. We've built everything in-house. We understand how it works. Our engineers have built it themselves. Of course, it's DeFi, so you build also on what's been there before, but forking isn't that easy and straightforward as you might think it is. And then you have to extend it with your own capabilities and your own, like for instance, liquidation mechanisms that we did. And then you need a very good team of auditors, which is, again, easier said than done, because there's a lot of names out there, and big names that people recognize, and they think, okay, the stamp from these guys means it's okay. But it's not, because often the biggest names are like the worst auditors, and they're in it to and not really understand. They just check their checklist, tick the boxes, and okay, they get their, the 100,000, 200,000, 500,000 fee. And a team has to be willing to spend the money on auditors, and we have done that. So we were lucky that we were able to do that. But I think a lot of teams that are building fast, breaking easy, don't have that funding from the outset. They're just not able to do that, and then it's easy to cut corners, especially on audits.
Okay. Now, as an end user, let's go back to FXD. Okay. Could you tell us a couple of use cases? And if I'm holding FXD right now, how do I convert that? Is there a conversion mechanism available?
Yeah, so that's a good question. So you have FXD, which represents really a US dollar on-chain, right? So what can you do with it? So in our case, and going back to XDC, it is used as a base currency for a lot of these real-world assets. So you can supply FXD and buy a real-world asset, which provides you a yield back again in FXD.
Yeah.
So that makes, and we've had like I think a dozen or so pools on TradeFinex, for instance, that are denominated in FXD.
Do you guys create your own liquidity pools, or do you use third parties?
No, we use third parties. So so we have these issuers of these real-world assets. They want to sell their fund, and then people can come with FXD and buy it. They can buy it from a pool on TradeFinex, for instance, or we recently launched our Vault product, where people can put it straight away on our protocol. So you can buy a range of investments. It's early days. This is still very young protocol. It's just been in production since January or so of this year, and so a lot of it's coming, of course. So investing is one thing, trading is one thing. A lot of the trading pairs on DeFi on XDC are denominated both in XDC and in FXD. You can trade also in centralized exchanges.
Let me stop you there. For the RWA vaults, let's go a little more in depth on that and talk about the real world asset vaults provided by Fathom.
So we have this thing called vaults, where people can come with stablecoin and buy into an asset, or even a combination of assets. We have two things. One thing is called vaults, and then within vaults you have strategies. You can think of it like a portfolio, like a fund, and a vault contain many strategies. You could even build an index like it, famous indices like S&P.
Traditional finance. Yeah, I gotcha.
And it's called direct indexing. So you could also act as an asset manager and build your own direct index or fund, and then invite people to come with their stable coins and invest in it, and then return the yield after 3 months or 6 months or so. So that's kind of the cool thing about it. For asset managers. You can be your own asset manager, and you can just be an investor looking for yield.
As an end user, do you feel it's more about the yield or holding these variety of different types of assets?
So if you're if you're an investor as an end user, yield is of course very important, but you always have to risk weigh it, right? So I used to work as a risk manager, and yield is great, but on a risk adjusted basis, it might be less great, right? So diversification is usually a good thing. So if you put all your eggs into one basket, as you know, your proverb, then you really have to watch that basket very well, very closely, and people tend not to have the time for that.
Right.
So
yeah, I got my head cracked, so it happens for sure.
Oh yeah, me too. Even though I am. And so the other thing you can do with these vaults, they can be programmed, they can be configured as automated asset managers. So they can go and say, okay, we take these stable coins, and then we have the strategy to go and do a basis trade on these two DEXs, or we can go and invest in that other pool over there, and then take that liquidity token that we got from that pool and then reinvest it somewhere else, etc. So you can build very complex, completely programmed investment strategies with it. So that's kind of cool. Yeah.
The way you were just explaining that, I was thinking about a couple months ago, I was doing a strategy like that to where I put my liquidity into a specific protocol, received my collateral back, and then I put that into a different pool and did that 6 different times in a row, all off the same funds, but it was borrowing against myself, under collateralized or over collateralized, however that works. And I was taking the liquidity I had left and just kept moving it into different types of assets. So that's really unique and a real cool concept for sure.
So that makes you a degen, right? As it's called.
Okay, yep.
Somebody who understands DeFi, and you have to spend a bit of time on it. And it involves farming those liquidity tokens. The vault can do all that automatically, so you don't have to be a degen. You just go in, let the thing do its magic, and then come out.
Now, do you see more crypto users using this product or traditional finance users?
So, I mean, there aren't that many crypto users, right? If you look at it relatively. So degens like you and me, it's great. And there's money to be made there. It's interesting. You actually learn a lot as well. But how many of us are there? I mean, I don't know, a few million maybe. But it's not really people like us that are going to scale. DeFi, right? For scale, you need institutions who have the clients, who have the assets. And so right now, I think it's mainly, degens like us. But
people who understand the industry, we're limited to that amount of people. But when you look at the larger scale of the opportunity at hand, there's 7 billion people in the world that don't understand this technology, and we need to make it easier for them to understand and use these types of products. Absolutely. And that's what the Vault provides.
Well, that's what I think the protocol as a whole provides. And also what a stablecoin provides, right? So a stablecoin is it's kind of easy, right? So when US dollars, so what do you do with US dollars? Now it's on-chain, but like a real use case is that we've seen talking to our institutional partners is where you have commodity traders and commodity exporters and importers using stablecoins to buy and pay for commodities and sell commodities, rather than using, if you export from Thailand to Indonesia, you might have, in US dollars, you might have to deal with 2 banks in Thailand, 2 in the US and 2 in Indonesia, all with their own schedules and fees and a lot of friction and a lot of scope for failure. You could replace that with one ledger, one asset, one ledger, and optionally one custodian. So for these guys, it's a convenience thing, and it's a cost thing, and it's a time thing. And here you have like real. It's easy to imagine use cases where blockchain stablecoins on blockchain just work better for financial institutions than the current patchwork of intermediary banks. So this is where we see early adopters now, and with a bit of regulatory help, I think we can also bring these yield opportunities to the masses, where the bank accesses front end, but in the back end you have all this program efficiency produced by programmability and distribution channels, and just the global character of it all that is able to deliver those yields for savers, and is able to deliver financing solutions for small and medium enterprises, right? Financing that they are not getting at this time, and they're getting less and less because banks are de-risking, as it's called, and so they're very scared of lending, for instance, to exporters. But it's coming.
Now, let's transition into FHTM, your governance token for the Fathom protocol.
FTHM, which stands for Fathom, is, as we say, the governance token. It is ruled by the DAO, a Decentralized Autonomous Organization, which we actually registered. There is the possibility to register as a DAO in the Marshall Islands, and that's what we did. And it's a programmatic DAO. That means that people can create a proposal, and if you vote your tokens for that proposal, against that proposal, then that proposal is accepted or rejected programmatically. There's no horse trading on there. And so what kind of proposals are kind of the key?
That was my next question, so you beat me to it.
So you have to realize that the DAO, the protocol itself has like 10 different, or maybe even more, revenue lines, fees that it collects on, like a stability fee on the CDP, like DEX trading fees, like vault fees, management fees, and or performance fees. And so there's about 12 of those, and there's a revenue pool. And what do you do with that revenue pool? So we as a team cannot just take that revenue for ourselves. So the DAO is used to distribute the revenue pool in the form of incentives and rewards to the DAO, to the Fathom token holders. So that's a major use case with utility use case. And then another very important one is, of course, we talked about the importance of having quality collateral in the protocol, so people can vote on the onboarding of a new collateral type. So, for instance, we want to onboard XDC master nodes into the CDP, then that will have to be voted for by the DAO. The DAO says no, then it's no.
So, I'm trying to think of, from an end user perspective, what types of assets do you see end users trying to bring to the table
that
might not be included in the protocol so far?
So if you look at end users, so if you look at institutions, they'll be looking what they have on their books. They'll have treasuries on their books, for instance, and they'll bring that. If you look at retail, so there's also a lending protocol on. Lending is part of our protocol, and you can come with, or the DEX, you can come with any token that is
XDC based?
On XDC, exactly, and borrow or lend against that. And how we do curate the interface. So, for instance, we haven't opened up the interface. The smart contract is, as you know, it's there. Nothing we can do about it. With the interface, we do curate, like the best in the industry do as well, like Uniswap and everybody else basically. But if you come to the DAO or the proposal for the addition of a good collateral type, then it'll be accepted. We'll also.
That's what I was trying to get at. For retail users, how do they present a proposal?
So there is a proposal mechanism. It's very easy on the interface. We just created a proposal, by the way, where we proposed an airdrop. Maybe we can talk about it as well.
Okay.
It takes about 2 minutes. It's very it's on the, if you go on the DAO section of the website, you can add new proposals. Now, at the moment, there is a limit. There is, again, because it's a young protocol, and decentralization is on a spectrum, and we're getting there. But right now, you need a million Fathom tokens to make such a proposal.
Create a proposal. Okay,
Yeah.
That's what I was trying to get at. I was trying to understand that aspect. So for a retail user who wants to present an option that you guys could include in the future, you need 1 million Fathom tokens?
Yeah, if it's kind of an important proposal, right? If it's
Okay.
If it's a minor thing, then we also
What are some types of minor proposals, would you say?
if there's anything to do with the interface, for instance, interface
Okay.
changes, or I don't know, we're not getting that many at the moment. We operate a group on Twitter, of course, and on Telegram, and we get some recommendations, and of course, a lot of these recommendations don't need the DAO proposal because they're not that significant.
I guess what I'm trying to understand is it more visually versus protocol for these proposals? Is a protocol proposal higher tier than a visual proposal?
Yeah, for sure. So if you're asking us to add Dogecoin as collateral, that's an important decision for the protocol because it impacts the risk management of the protocol. Or if you or adding synthetics, for instance, that's very important. If you instead of that want a slightly different look of how you can vote on the website, that's minor.
All right. So to conclude this interview, could you give the listeners your website, your Twitter account, any social media, how they can contact Fathom in the future?
Yeah, sure. So our website is fathom.fi, so FATHOM.fi. On there, you'll see the links to our social media. On Twitter, I happen to know it's at Fathom_FI.
Well, this has been a pleasure. This has been RWA and DeFi Ecosystems featuring Fathom. Thank you for being here, brother.